Good evening, ladies and gentlemen. Now we come to the meat of it. Through the day, you've heard lots of things about the macro and all of that, but this is what you've come to hear: how you make money and how you beat the market. Three very experienced practitioners of all that with me. I don't need to introduce them. Raamdeo, Shankar, and Nikhil, all of them you know very well. Nikhil's the youngest, but he's been remarkably successful with Zerodha over the last few years. So my hat's off to him for what he and his brother have achieved over the last few years. He's also the most handsome man on stage of all of us, by quite a distance, though Shankar would dispute that. But Shankar, what's going on? In the last year, 60-70% of the PMSs and the mutual funds who investors pay 2-3% a year to manage their money have underperformed the Nifty. When you ask them what's going on, sometimes they say, last year they said because it was commodity stocks and we don't own commodities. This year they're saying because they were those rubbish PSUs and we don't own them naturally. What's the right way to look at it? I mean, it's only when their blue chip HDFC Bank does well, they are expected to beat the market? How do you explain this kind of underperformance? The lack of alpha?
Yeah, so last 12 months, I think it was Adani Group which was the problem area.
Nobody had them.
Nobody had them. And to be fair, I mean, let's be fair that fundamentally a lot of the stocks that did well, particularly this group, could not be justifiably held in a fund structure. You could hold it in your personal investing because, it's okay when then they go up 10 times or maybe 20 times. But there is no real, if you say fundamental on the ground reality because of which these valuations were deserved. I'm not disputing that that figure is incorrect. All I'm saying is justifying that for a fund manager to his shareholders, to his investors, to the unit holders, to the regulator, if something were to go wrong, becomes a major problem. So you cannot play every game that is being played in the markets. It's not possible. So to be fair, the underperformance has come because of this one major factor. The Nifty has done better because of this. If you look at the difference between the Nifty and the small cap, that itself is telling you a lot of things. That small cap on an index level has not done as well. So, but the fact is there will be something that will do very well. People are underinvested. And the law of the market is very simple, that the money gets made where people are least invested. And there is no real reason why you should be investing in the least invested. But usually that's the place where you end up making most of the money. Okay. And unfortunately, the incentive structure for a fund manager is geared towards retention of assets and hopefully some growth. It is not really a structure in which you're being paid to take a fair amount of risk. And that stems from the investors into fund or PMSs. And I can tell you, I've run these structures, and investors are the worst enemies, I can tell you this, because what they want is an impossible set of combinations. They want you to beat the market. They don't want you to lose money when the market falls, all in the same stock or the same group of stocks. That's not possible. These are impossible objectives to manage at the very same point in time. It's not going to happen. Right. And which is why you will find an odd fund which took the bet, let's say on Adani or in commodities, they will beat the daylights out of the market for a year. Okay, whether they'll repeat it or not, who knows. So the short answer to your question, Udayan, is that it's been a very tough environment in an organized form of fund management. Very, very, very tough. The headline index is not telling you what the underlying trade change has been. HDFC banks or levers or Asian Paints, they have been dogs, while the underdogs have become the big dogs. Welcome to the markets.
Yeah. Raamdeo, what about this trend of public sector stocks, which did very well? And many fund managers traditionally have not owned these names, the Coal Indias, the Power Grids, NTPCs. What do you do as a fund manager when you see these kind of stocks coming back and beating the daylights of your core blue chip holdings?
So it's a problem in the sense that the markets are markets and...
Is your mic working?
Yeah. Yes. You have to hold it closer.
Yeah. So markets are markets, and they will go, like one of the things which is happening is that because of sustained fall in the interest rate for last 10, 12 years, there was a method of madness in the sense that all kinds of growth story, whether it is profit making or not profit making, they are going through the roof. Just 12 months back, we were talking about Zomato and Nykaa and all. Today we are talking about public sector bank. Just see the contrast. How, what do you expect? I mean, fund manager cannot move 1 lakh crore from, I'm not saying that Zomato and Nykaa, but say from Avenue Supermart or Asian Paints and all those bluest of blue chips to, some public sector banks and all. It is, that's not the mandate. I mean, I would say that it is impossible to do it. So, but that's what market has done. So I think there is somewhere very deep, I'm all the way growth investor, good time, bad time, but clearly somewhere value is asserting. There is a very strong value rally right now. Maybe it was overdone on growth side, and even the decline in the interest rate was also overdone. So, like whatever the pendulum is swinging from that 18, 17, 18% 10 year in 81, 82 to literally zero to now maybe 3, 4%, but definitely not minus 20. So from 0 to maybe 3, 4%, 5%. So there is a clearly change of cycle there, and we are still struggling with accepting it. What has happened. But even now, today, the same companies are still cheaper than your growth companies.
True. Nikhil, is it driving local investors?
To add here,
Sure.
as a follow-up answer to your question, Udayan. In the 90s, when most of us were born in the 90s in this business, and a lot of the mutual fund managers who have great 25-year records, who became CIOs and then some of them retired, I can tell you one thing. A lot of the performance actually stemmed from 4 or 5 years of from 95 up until 2000. And I'll tell you why. I'm talking the index beating. Because the tech sector, the TMT sector, okay, Infosys, Wipro, Z and all that, they did not have any participation in the Sensex. Okay, so the Sensex actually did nothing between 96 and 2000. If anything, it was probably down a bit. But everybody had tech. And they beat the daylights out of the index. Okay, they beat it by like 10, 20% points every year. Now that put performance points into your bank, which you ate off for the remainder of your career for 20 years. So you cannot complain that, look, the market is moving in a direction where I am underinvested, because you were in a underinvested area, which was not in the index, that did phenomenally well, beat the market. The market did not have those stocks in the index. So, the market cuts both ways. I mean, so we cannot really complain. I'm just pointing out historical facts so that we understand that the markets usually are a tricky place to be in, and we can't just make 1% for doing nothing.
True. Nikhil, is it driving a class of local investors towards passive investing? Because they look at the index and say, I pay 0.2% just buy the index. And that's good enough from these fancy investors you pay so much money for to manage my money. Is that a fair point, or do you think active investment will actually beat passive investors in the medium term?
So, Udayan, it's a tough answer because we have an active management fund.
I know.
If you look at it historically, I think passive has done better. That 1-2% a year, if you were to compound that over 20 years, mathematically, I think it is quite hard for an active fund to beat a passive fund. And
Even in India. People think it's in the US. In India, it'll be different.
Well, if somebody is charging 2% every year for 20 years, that's a significant portion of your corpus. That being said, I think active does better in flat markets or range-bound markets, and passive probably does better in trending markets. Considering how expensive the markets are today relative to the rest of the world, maybe there is a case to be made why active could do better in the next 2 or 3 years when Nifty doesn't give stellar returns. But over a long term, I think passive will continue to outperform because our fee structures are not efficient enough. I don't think anybody can really bring in alpha for a client charging 2%, having a distributor in the beginning who charges a fee and an exit load and all of that. I think it will be quite hard in that model for active to actually outperform.
That's remarkably candid of you to say it because you are in that game yourself. Are you doing something to disrupt that or change that?
Well, I would say we are trying, but I don't think we're doing anything significantly different to warrant a change, to kind of, weigh the scale more towards the active narrative. We are charging much lesser and stuff like that, but I don't think that one thing is enough because we're still charging maybe 10% of carry, and to get that much alpha is quite hard over the long term.
Shankar.
I'll tell you one simple golden formula to beat the market as an active fund manager, okay? And that is if you get the bear market right. Because your biggest alpha will come when the market falls 40 and you're falling only 20 or 10. In a bull market, you will not be able to beat the index. Impossible. And therefore, if you have the skills to get a bear market right, and you fall half the market, you fall 25% of the market, you have put 20% point in the bag, and then you will gradually fritter it away over a 3-4 year period to still end up ahead in the game. And which is why it's an underappreciated skill to get the bear market right. Okay? And bull market, ultimately bull market, most people will have similar stocks. It's very hard to be away from, the consensus trade. So therefore, the skill where you can add value as an active manager is to get the bear market right. And occasionally, if you get that right, and I think every 3-4 years you will get a down year, just make sure you get that part right.
When is the next bear market according to you, Shankar?
I don't think it's happening anytime soon, which is a problem for active managers. Okay, it happened, 2 years back, in COVID. Now, if you were alert enough, you could have seen that. I mean, it was not difficult to spot that there was some degree of fall coming, not a bear market, maybe not a huge bear market, but I think from February 2020, there was enough data and the screen was telling you from Japan up until Italy, schools are closing down and everything. I mean, that was not like a SARS virus. It was very clear this was a catastrophe, a calamity, and they would have some impact. So if you positioned yourself through some hedges or if you could shorten your structure, I think you would have made significant alpha right there. In a month, you could have been up 20% relative to the market if you were smart enough to do that.
Raamdeo, you've had a very long career in the market. How do you do it? Because every year there is some distraction. Sometimes it is digital stocks, which you may or may not own, which are going up. Sometimes it's commodities, which are having a bull run, which you may or may not have. Do you just say, I forget the noise and stick to my 20 stocks, which I know? Because it's easier said than done, right?
More like if you ask me personally, I'm more like a prop investor who doesn't care so much about 12 months appraisal. And I'm buy and hold. And the longer run, if there is in the QGLP framework, if you have bought good quality stocks at reasonable good price, and your holding period is long. See, even if you get the price wrong to start with, but if your holding period is 10, 15, 20 years, then what happens is that even if you have paid a little more, it doesn't hurt. The growth G is equal to R. That's what I practice and it used to work very well. But what has happened is that the kind of stock prices we have seen in last 5-7 years, even today, is absolutely absurd. We used to get good stocks in 90. Our problem is that we have seen 40 years of the market. And we have seen Asian Paints at 17, 18 P multiple and we didn't want to pay 15, 16. That's the kind of history we started with. Then it became 22, 25. Now you are talking about 80 or 100. That doesn't fit into my psyche. So that's a bigger challenge. How do you buy at 80p and still make money? That doesn't work with me.
I know, but sometimes does it lead to you making mistakes? Like last year, you did buy some digital stocks. Do you regret that? Was that a mistake?
Yeah, that was a clear mistake.
Which one did you buy?
I bought Zomato.
Only Zomato?
Only Zomato.
If you on hindsight, would you have bought it or you should have not have ventured?
I should have not even bothered. See, actually, I don't bother about any IPO.
Why did you buy it then?
But my fund managers, they were on my head. They were telling me, sir, use your office to get some allocation. I'm telling you, this is the truth. So, then for me also to pick up the phone and talk to the company, they convinced me, sir, this is a terrific thing. So that's how, and then you get sucked in. One guy, two guys, they have better degrees than me. So, you start, and then environment is like that. There's so much of demand. The management is worshipped. They don't come to Mumbai. They have to come and meet. They don't even declare quarterly results properly. They have their own formats. All kinds of nonsense. And still you get into that. See, that optimistic market, you get this. Last time in 2008, I got sucked into Central Bank of India. Can you believe this?
Central Bank of
Central
India?
Bank of India. At the peak of 2008 boom, I ended up buying Central Bank big time. So you get sucked in. Because then right now nobody wants to believe PSU Bank. I'm telling you, in 2 years' time, the most coveted blue chips will be PSU banks. PSU banks. Because there will be sustained performance. This is a credit cycle. Credit cycles are 3, 4, 5 years. This is the most reliable cycle if there is one. Any cycle which is reliable is credit cycle. So 3, 4 years, once, say, it has started turning around. We have only published a report, Motilal Oswal has published a report, where they are saying that PSU banks, they made losses 2 years back. Aggregate, they made 10, 15, 20,000 crore losses. In I think 24 or 25, they are predicting 1 lakh crore plus profit. Now, market is not going to be, they won't be discounting at 5 P multiple only. So 5 goes to 10, and the earnings come to 20, say 15, 20% also. You see what kind of stock performance is going to be there.
Okay, that's a stock record right there. Nikhil, what do you do with the problem that Raamdeo just described? Because, I have heard you talk about that as well, that some of these valuations you cannot just justify. Yet, Asian Paints goes from 50 to 60 to 70 to 80 P multiple. As a fund manager, how do you look at that when you see this explosion in multiples happening?
Well, it's hard, Udayan, but I think these valuations correct from time to time. Maybe not inside of a 10-year cycle, but longer than that. For a fund to have the freedom to kind of have a higher allocation to things like debt and commodity, I think become increasingly relevant. Mm-hmm. So when you see valuations are so high, if I have the freedom to have 50% into debt and commodity, for example, I think that helps a lot in catering to this particular problem. Mm. But like Raamdeo was saying, I agree with him. Many times I think we are forced to take some kind of an allocation or participation because there is pressure from investors on the fund. But I guess because of what happened last year, I hope people wisen up this year and next year, because I don't think the retail will treat them so kindly when they come into the market with not too much profit but crazy valuations.
Mm. But I remember you did not make that same Zomato mistake last year. We spoke once and you said at 125, there's no way, gun to my head, I won't buy that stock. Have you changed your mind at $50 to Zomato?
Well, I still haven't. See, I'm also a part of the startup ecosystem, and I kind of meet and know most of the unicorn founders, and we all hang out and stuff like that. This problem of not being able to raise money at the valuations of last year, I think we're at the very beginning of the pain. I don't think we have seen it yet. The cost of capital for a foreign PE or VC was probably 2% last year. Today it sits at 6%, and their risk-taking ability will totally be changed by virtue of that. So there will be down rounds. If people in America are firing 10% of their workforce, and I'm not talking about companies that are not profitable, but companies which are in some cases sitting with billions of dollars of cash on their book, if that is going to happen there, it will also happen here. I think the timing is something one cannot call. So I think the next year or two will be reasonably hard, not just in the West, but also in India.
Shankar, you're about to launch. No, I will ask you about tech, but I want to ask you more urgently about the stuff that you're getting into now, which is small caps, which is what people want to hear about. Do you think in this kind of environment, small caps will end up beating large cap blue chips hands down? Your fund is going to be largely a small cap fund, right?
Yeah, no, the fund is different. Fund cannot do only small cap, because I've always believed this. Investing in small caps is like joining the mafia, right? It's very easy to enter, but it's impossible to exit. So you have to be very, very careful when you talk small caps. There are all kinds of companies out there, and I was in Dubai, on Sunday, And I thought Sunday was going to be a relaxing day. And I ended up having 5 meetings with 5 small cap promoters on a Sunday
Indians?
in Dubai.
No, Indian promoters.
Indian promoters
All of them.
in Dubai who had come to see me, and they said, Sunday ko, "Arey yaar, Sunday ko kam se kam aaram karne do." I was catching a flight for Bombay that night. So there is this whole, all kinds of promoters crawling out of the woodworks. Each one has a great story. But I can tell you many will fall by the wayside, and therefore it is a very treacherous area of the market. I just want to be very clear about it. However, my view is this, that yesterday's story is over, meaning your Asian Paints, HDFC Bank, Kotak Banks and all that, they are not going to give you any money worth the while at all.
Not even beat the index?
No, I'm 100%. I've been clear for the last 2 or 3 years. Okay, because there was enough data to show that they had run out their course in terms of valuation expansion. And now, even if they grow, the multiples will keep compressing instead of the multiple remaining constant or expanding. Okay, so I've been very clear on that trade. And, some of the numbers, HDFC Bank, not bad, but I mean, the market is already saying that, I've had enough of this. So the trade has changed. Fund managers may or may not change, but the trade has changed, right? So small caps is where money will get made. It is also the place where you'll get taken out to the cleaners for sure. So if you want a simplified back of the envelope advice, buy 50 of them, put 1 or 2% of your investable capital into each, and then hope that 5 of them will become 20x or 40x, which statistically will happen. It has to happen. That's the way the game works. If you think each of them is going to be 20x, forget about it. Many of them will become reverse compounders. Meaning at the price you bought, they will keep halving from every price till they go to 0. And, you will see that happening. But I just wanted to add to what Nikhil was saying. And the venture capital ecosystem has distorted the whole spectrum of IPOs, of valuations, everything. And we saw that story 22 years back in the dot-com boom as well. That time people had a website and hence they got valuation. Now people have an app and hence they get the valuation. Okay, but there is nothing in the middle. Okay, so I was looking at the data, broad, back of the envelope. Which are the greatest companies in the world? And first of all, why do you call a company great? Okay, in my view, there is only one metric that defines a company's greatness. Sustained long-term returns to shareholders. You can make money, lose money, free cash flow, not free cash flow, ROE, nobody really gives a damn. Agar 10-20 saal mein you are compounded 20% plus, you consider it a great company. Now look at the history. Apple listed in 1985. I think Microsoft listed around the same time, a year later. Okay, they were in their infancy. They were virtually in a garage or just outside a garage. Tiny companies. They listed right there. Amazon listed 1996, within I think 2 years of starting the bookstore. Okay, very early in the journey. Infosys listed 1994, almost like it was still a startup in every sense of the word. Correct? HDFC Bank, it listed when it was Worli and a few other branch offices. That defines how much returns your stockholders make. And all these are great companies in hindsight because they listed very early in their corporate journey. They did not have venture capital coming in the middle, providing the unlisted capital, whipping up the valuations, and then IPOing out when the businesses or the growth cycle was kind of coming to a near peak. And they distorted the entire return spectrum by capturing the return from start to the midpoint for themselves and then leaving the stock market, the IPO market, to fend for itself by listing those companies when they've already more or less sucked the juice out of the returns of those companies. So my view is that small cap investing, I am saying to every promoter who's got a good business model, please list as early as possible. Let the retail be your venture capitalist. In which case they will lose money in some, but the 20-50 Xers will come out of those because what is being taken away by the VCs should now come to the retail investor.
Fair enough. Okay. Raamdeo, how do you go about investing in mid caps and small caps? Because that is what causes such a lot of excitement for the retail investors. You've had tremendous experience with successes, but you've also had your failures. Can you just give us 1 or 2 examples of mistakes you made? What are the ones which really worked out and what you took away from those?
Yeah. Then, what I've seen in last 20, 30 years is that the opportunities come. See, you have a framework. I work with the framework. I have a framework. I'm looking for a certain story to build up. And say I saw first time mobile phone and I was damn excited. It's a network business. I had read book by Michael Mobison and how it is going to work. Now I was looking for a network business opportunity in 2003. And Bharti came with IPO at $45. Immediately they bid it down to $19 because it was making losses. Same situation like what is happening now. So they bid it down to 1920. We didn't know. I was very clear at 45 it is useless company. So the banker was known to me. He was saying, you guys don't know how to value a mobile company. At that time, mobile was a new frontier. So I said, you guys don't know how the stock market works. यहाँ जो दिखता है वो बिकता है. आप प्रॉफिट नहीं कमा रहे तो हमारे लिए जीरो वैल्यू. यू आर यूजलेस. मतलब डोंट टॉक टू मी. आप करो जो करने का है. Then in 2003, Sunil Bharti Mittal announced we are broken even. Then you could see it's a quarter on quarter 25-30% kind of growth. So I'm all the way growth investor. If I can find a company in mid cap, mid cap is a good place to start. Small cap is they are small because they need to be small. Kind of useless fellows. So like they cannot think of big. I mean HDFC Bank, I know I was the first investor at $40 when 1,000 crores market cap was there. So very small is, I would think they will never make it to the big board. It is the mid-sized companies like iShares, your Bharti, or even HDFC Bank. When it started, I think it was less than 100 rank company on day one. Infosys at 400 crores or 500 crores they started. That time it was a little obscure in terms of software, but still they were not that small. I mean in 93, 94, to have 400 crores market cap was good. So I think we should start somewhere at the mid or something like that. And there if I get a story which I think, because I read the paper every day, it is a surprise to me that this kind of story can build up. Return can be very high. That's where I think I have made money and I think there are enough stories.
No, one mid-cap mistake you made, just to illustrate to the audience what you should not be doing. A recent example of a mid-cap mistake that you made.
So I told you.
No, that's digital. That's a different league. I mean, regular company.
Yeah, so there was, I don't want to name the companies, don't like
Hey,
it.
come on, you just said.
Okay. So I got the story of Sterlite Technology. When the,
Sterlite Tech, okay.
Yeah, Sterlite Tech, when it was making only that digital cable. What is that? Optical
Optic
cable.
fiber cable.
Okay, and there was a boom globally. I didn't know the difference between commodity and consistent companies and those kind of things. And it was seriously making a lot of money. I heard about this story at $100. By the time I could make up my mind, it was $300. And by the time I bought it, it was 500 rupees. The moment I completed the buying, so don't chase your stocks too much. So the moment I bought, I saw a price of 750 and before I could enjoy, it was again dropped to below my purchase price. And by the time I sold it, I must have sold at 50% loss. So and now I think the fight is even more deeper. Cost of getting entered into a smaller company is extremely high. And if by chance you go wrong, then you are completely cleaned up by the time you get out. And particularly when you are running public money, it's a nightmare. Yeah. If you're running a private money, still you can pace it up. Your quantity will be small. So I think audience, if they are running private money, perfectly all right to do small cap, even small mid caps. It's actually, that's the place actually they have the advantage. The upper side is so intensely researched. I mean, the managements tell us, this is, I'm telling only to you. Okay, when you come out of the room.
In front of a few hundred people, it's all right.
So when they come out of the room, the next guy says, this is what he told me. So everywhere he is telling the same thing. I'm only telling to you. So you have no advantage in the large caps. True. Even management is trying to give you something which he doesn't know about the company. And it's already priced in. So I think, guys, we have to be very careful when we are buying very large cap. It is better that fund managers only battle it out day in, day out. In mid and small, you have a great chance to be ahead of the market because that is not being researched.
Nikhil, what's your recipe for creating alpha? Because there are various approaches. Some say you must have a long short approach. You buy some and you short some. Some say do a multi-asset play that will smoothen out the rough edges and you will create alpha. What's your strategy?
Well, what we've been trying to attempt is the multi-asset class approach. But to be candid, Udayan, I don't think there is a recipe because we haven't figured out how to do it yet.
Okay.
What we are attempting to do is take advantage of many discrepancies in the market to try and create as little as 20 to 30 bips of alpha a month. That's what we set out to do. We've largely done that over the last 3 years, but we've been able to do that because markets were not as efficient then as they are now. And progressively, as they get more efficient, it will get harder for us to find that alpha. We also have a mandate that we stick to large caps alone. Unlike what he was saying, Mr. Raamdeo was saying, I find it easier to invest in large cap companies because I do not have to worry too much about the compliance and governance aspects of them. When you go to a smaller company, you need to put in incrementally a lot more work, and you will still be wary of whatever is being reported is above board. So I recommend that, investors as well, whenever you're looking at companies, stick to something that 100 other people are researching, because if something has to be caught, it's probably caught by then.
Except in Satyam, they never caught it. Don't you remember?
Yeah.
No, but the thing is, I mean, I agree there is hopefully better governance in the larger caps, hopefully. But, the fact is, we will make money where there is danger. Where there is extreme safety, there is no money. It's well discounted. Everybody knows it. And frankly, I think the biggest marketing success in Indian fund management has been that of a fund which marketed HDFC Bank, Asian Paints, and all these old stories as something absolutely new. And gathered.
He was here this morning.
I believe so. And gathered AUM, when people are paying you money to buy HDFC Bank and Asian Paints, I don't think that the bigger set of idiots in this whole planet. Trust me. It's absolutely ridiculous. These companies are well discovered. They have great governance. They have great ROEs, great cash flows, great everything. And why should you anyway pay somebody to put money into those, and only those? If you're putting that as part of a larger, little dangerous companies also, I can still get that. But just in those 10 names, I really don't get it. So the fact is, there is danger wherever there is money. Okay, and that is what we are getting paid to do as professional managers, to sift out the least dangerous of this lot. Because if you just completely avoid them, then so many companies were small caps back then. Okay, in the 90s, which became huge companies. They are missing out on that chance to get the next Infosys, or the next Bharti also.
Sure. Nikhil, what's the current strategy? You were going to tell us what are you doing right now to create alpha?
So, Udayan, honestly, to second what I was saying earlier, we've reduced our equity allocation a lot.
To how much, roughly?
To about 37%.
That's it?
Yeah. We've increased gold considerably, about 10-15% gold, and the rest is in debt. Nowadays, you're getting AA paper, reasonably good paper at around 9%. If one were to assume stock markets traditionally give out about 10-11% a year, you really ask yourself, is that additional 2% worth all the volatility and all the chaos that comes along with it? So we have a larger chunk than usual in fixed income right now.
Okay. Shankar, one tenet of investing for many Indian investors is exactly the opposite of what you're saying. Basically, buy the blue chips and forget about it. In the long run, you'll be okay. But you're saying that will not necessarily work in beating the market.
No, I'm not saying it's either or. I'm saying you can do both. You should have a decent allocation. I'm not saying what is a blue chip is all up in the air anyway. A blue chip, in my view, that makes money for investors.
So Asian Paints, HDFC Bank.
They are good company. They may or may not be. I might want to buy their debt instead of buying their equity. But the point is very simple. It should not be an extremist approach that I'm going to buy only those and not this, and only the small caps and not the large caps. Ultimately, it's about balance, and balance will give you stability. It will not blow out the lights. Let's be clear about it. And investing, in my view, on a fund basis cannot be about blowing out the lights. It's about staying in the game without getting injured in a bad. On my prop side, I'm willing to take that risk. I'm willing to meet 5 promoters on a Sunday and, lose money on 4, but make in one almost like a VC approach to investing. But on a fund basis, it's impossible. Nobody will, I mean, you will get killed if you were to adopt that kind of strategy.
Right. Raamdeo, you just spoke to us about public sector banks, that the credit cycle is starting, next 2-3 years will be great for them. But we know that these credit cycles, they make a lot of money, but it almost always ends quite badly for them. After 3-4 years, there might be trouble again. I want to ask you about selling. How do you decide when to sell a stock and get out? Because everything is cyclical. It does well for a while, and then there is a time to sell it. Contrary to the theory that you should get married to the great stocks forever. When do you sell? When will you sell your PSU banks?
PSU banks, the moment it doubles, get out.
Just double.
Yeah, I mean, you have a price target, double, 50%, whatever, in 3 months, if you get 50%, run. Because this is not buy and hold, for sure. This time, I realized that buy and hold has to be the consistent companies. The companies which have a terrific track record. I think what we invest a lot more on trying to understand the future. Actually, we should spend 2/3, 70-80% time in trying to understand the past of the company. And past tells you a lot more about the future. Because future is uncertain, very few can predict it. In fact, the entrepreneur himself doesn't know. You ask me what is the future of my company, it's very tough. Future is bright, for sure. But if you ask me a specific number, I can't give you. Actually, I don't have a number. So that's the case with all the entrepreneurs. They have very little knowledge, but unless they think that they know everything about future, without bothering about the past. Past has been completely wretched. They have not made money. Return on equity have been 2-3%. Pathetic track record. But from here onwards, it is going to make in their Excel sheet 25-30% compounded. And that's what we buy. So I think from here onwards, I'm going to focus a lot more on knowing the company's past. Not that I was not knowing, but even the companies I was holding, I was not knowing enough. So I think one message is very clear. Please know in every aspect of life, you do a lot more study of the past for the marriage, for the hiring a manager. You look at the only past. Because the manager is going to say, I'm going to do all the wonders. So.
Okay. Shankar, what's the next couple of years going to be like for the market, you think? We've just come out of a very ordinary patch last year. We did better than the rest of the world, but returns were average. What's it looking like from here?
No, I think if I look at the world and just go analytically from Japan down to South America, there are very, very few markets you can make sustainable money. And about the only market I see is India. And of course, I look at, I see Turkey as being a decent bet. I put a lot of money there and hopefully.
In Turkey?
Yeah, I've made a good amount. Actually, the index there is up 60% in dollar terms this year, by the way. It's beaten the daylights out of the Nifty. So it's been a good trade. So I mean, again, now there is danger. Everybody I talked to about Turkey said, "Tu pagal ho gaya kya? Sala ye koi country hai kya? Inflation 85%." I like such stories. Okay, I like those are the places. There's a lot of danger. So you will make some money there. So, but otherwise, I can tell you the mantra in investing is this: you have to be able to time the markets. You have to be able to time the cycles. You may remain invested, but invested in what? That's the key question. Sometimes stocks will do well, sometimes commodities will do well, sometimes your blue chips will do well, sometimes small caps. You need to be nimble. Fund managers are lazy. They are busier looking at asset gathering as a profession rather than being actively involved in understanding market cycles. And very few fund managers get that. I've been in the business long enough to know. Cycle nahi samajh mein aata inko. And that is where the problem of alpha generation lies.
Nikhil, last word with you. The few times I've spoken to you over the last year or so, you've sounded more circumspect than most of the others I speak to. I mean, they say India is a great story, bullish. You sound a bit more bearish. Why? I mean, are you still like that or have you changed your view?
I'm still like that. I think it's a disservice to people when everybody on TV always says bullish stuff, If I were a retail investor looking upon a TV channel for some advice and everybody is constantly saying, buy, buy, buy. And I'm not talking today, but every year over the last many decades, it's the same story. So if nothing else, I think one voice on the other side is useful. But outside of that, on a relative basis, I find more opportunity today. Say, I'll give you an example. Meta in America at 13, 14 times earnings probably looks more attractive to me compared to many of the tech stories in India. And if one were to truly argue, they are spending a lot more money on research and innovation than we are back home here in India. So I think there are stories like that outside which are available at a discount right now. Like Tesla is probably 30, 35 times 1 year forward earning or 2 year forward earnings. So as an international investor, if I were to be looking to allocate money today, why I choose India when we have not corrected and the rest of the world has corrected so much, I still don't know why exactly I am wagering on India today versus those companies at the discounts that they are available. Everybody says the India story is great, but if you go to another country, the narrative is the same in those countries in their own media, and people are saying exactly the same thing. For that reason, maybe I'm a little bit more skeptical than I have been in the past, more so this year than before, I think.
Great. Lovely hearing your thoughts, gentlemen, and to see you in the flesh after a long time. Thank you very much, all of you. Pleasure.